Professor J. Ritter as a keynote speaker in the context of the World Finance Conference. I would especially like to thank to the authorities of the Stock Exchange Foundation, especially President Adel Mugabi, who couldn't make it, he has another activity to do, and former Executive Director, Professor Blas Gonzalez. The institution and the representatives have been always so supportive to any activity which has connection with the world of finance. In this case, academic connection, and we are more than grateful for that. So thank you very much. I would like also to introduce Dr. Jose Maria Danilo Pastori, who is with us, who, among a very long list of academic and professional credentials, has graduated from Harvard in economics, and he has served twice as Ministry of Economy of the country. And he has held the position of the President of the National Academy of Economics. Dr. Danilo Pastore also understands the deep roots of connection between finance, capital markets, and economic growth. He will welcome you all and share some words as President of the Executive Committee of the Foundation. So please, Dr.
Good evening for everybody. In behalf of Buenos Aires Stock Exchange and its foundation, I want to give you a warm welcome to the authorities and the participants in this Buenos Aires edition of the World Finance Conference. The Buenos Aires Stock Exchange is an institution of over 150 years of existence. It has begun with creating a financial market in Argentina, and it has developed a family of sister institutions that provide the different services to the financial market in Argentina. Among its activities are a foundation, and it gives support to different projects in teaching, research, and extension related to financial activities. So it's very fitting that you will conduct your meetings in our premises, and I want to thank you very much to the authorities of the World Financial Conference and to Mr. Professor Jose da Pena, who has been a member of the Buenos Aires Stock Exchange Foundation for several years, for having selected us, our premises, to conduct your meetings. I anticipate a very fruitful meeting for you, since I know more than 200 academic papers have been presented for consideration. And we are very honored to have as a keynote speaker of the conference, Professor and speaker of the caliber of Professor J. Ritter, who is now here with us.
Now we will have the chance to listen to Professor J. Ritter. He has impressive credentials. When I asked him how to introduce in this panel, he told me, he has written so many papers, he has worked everywhere, but he told me, just say that I am named Mr. IPO, is that correct? And just say that I have studied with 8 Nobel Prize winners. So, you are engineers.
It's my pleasure to be here, and I'd like to note that I have 3 co-authors and numerous students in the audience. One of them, Melina, can guess where this photo was taken a few miles south of the University of Florida campus at Paynes Prairie. In the winter, the alligators aren't hungry. In the summer, I would not get that close. What I'd like to do is to take over where Pablo Fernandez left off yesterday, talking about the equity risk premium. Excuse me. Yesterday, he said there are 4 definitions. And actually, if I could have some water, that would probably be good. There's the historical equity risk premium, the expected equity risk premium, the implied equity risk premium, and the required equity risk premium, and these are not necessarily the same. When I started teaching finance 35 years ago, the first textbook I used was the Greeley and Myers first edition, where, as with most books, they were heavily emphasizing the historical equity risk premium as the right number to use. And that's what I taught. I believed it. And by a few years later, I was beginning to have my doubts, and then I went a few more years and decided, well, actually, that's completely wrong. First of all, one way of seeing that is if we just look at the historical evidence. This is a graph of the green bars are the compounded inflation-adjusted stock returns, capital gains plus dividends in, I think, 19 countries around the world from 1900 to 2011. If we added a few more years, the numbers aren't going to change much. These are the historical returns. Now, if we subtracted the risk-free rate or the real bond rate, then we would have the equity risk premium. These are geometric averages, not arithmetic averages. But if we were using that historical average as an estimate of the future, well, then for Australia and South Africa, the number would be about 7%, whereas for Italy and Belgium, it would only be about 2%. And why would anybody invest in Italy if you're only going to get an extra 2% when you could invest in South Africa and get 7%? This is not consistent with equilibrium. The yellow bars there are the average per capita growth rate of real income. And what we see there is that there's no relation. In fact, there's actually a slight negative relation between per capita economic growth and real stock returns. One of the other amazing things in this graph that surprises most people, including me, is that the highest returns are not from the United States, but South Africa and Australia. South Africa would have been the best place to invest in the last century, even though its economic growth per capita is lower than any of the other countries. Well, how do we estimate future stock returns? There are a couple of different approaches. One is using historical returns, extrapolating the past. And this is still heavily emphasized by a lot of textbooks. And if you think about it, it's just got to be wrong. If you use this procedure in Japan 25 years ago, at the peak of the Japanese stock bubble, historical returns had been really high. But the price-earnings ratio in Japan was 100. The market-to-book ratio was 10. The stock market was wildly overvalued. And if you paid attention to valuation ratios, you would conclude, as I did then, that the expected returns on Japanese equity were very low in the future because they had been very high in the past. The market had gotten into a bubble. But extrapolating the past, you would have assumed that the stock returns in Japan would be high in the future, and you would have been colossally wrong. 25 years later, the Japanese stock market is only at half the level it was at 25 years ago. The compounded real return, it turns out the dividend yield and the inflation rate have just about exactly canceled out. In the last 25 years, you would have gotten a minus 3% per year compounded return on Japanese stocks, just as you might have predicted if you paid attention to those high valuation ratios. Now, there's some other procedures that textbooks don't talk about too much. One is a theoretical model of what should stock returns be. And that was popularized by Ritter and Prescott in their 1985 paper on the equity risk premium, where they said, well, what's a plausible utility function? What's a plausible estimate of how risk-averse people are? How risky are stocks? How risky are T-bills and bonds? Well, given those parameters, what should the equilibrium equity risk premium be on theoretical grounds? And they concluded that the number was in the vicinity of 2% per year. A very low number relative to the historical average in the United States, although not below the historical average in Italy. But textbooks don't emphasize that number. Why not? Well, partly because it's so much lower than in the US and Australia and some other countries. And they don't like to deal with the fact that the theory is so at odds with the evidence. It's embarrassing. We all have trouble in the classroom teaching stuff when the theory is so different than the actual evidence. And that's why Ritter and Prescott called it the equity risk premium puzzle, that stocks were too good an investment relative to what they theoretically should have provided to investors. Now, another simple approach that's frequently used is the Gordon dividend growth model. And it's a very simple model. The expected return is the dividend yield plus the expected growth rate of real dividends per share. And that approach is frequently mentioned in books, textbooks, but because for individual stocks, first of all, some don't pay dividends at all, and secondly, figuring out the expected growth rate of dividends of stocks is not always easy to do. So while it's theoretically perfectly fine, in practice, very frequently, it's difficult to implement. What has become much more popular in recent years is the earnings yield model, which is popularized by Jeremy Siegel and Robert Schiller. And this is an incredibly simple model. It just says that the expected real return on stocks is equal to the earnings price ratio. Now, we all know that for an individual stock, this is not a very good model. You've got a company like Amazon.com that has negative earnings. Does that mean the expected return on Amazon.com is negative? I don't think any of us would say so. What about for another company, like many oil companies are selling at very low price earnings ratios today, very high earnings to price ratios, because people are expecting that their earnings will actually decline because oil prices have recently fallen. And for oil companies, the earnings yield is high, and nobody would say, well, that means that the expected return is really high if you buy the stock today. In equilibrium, if they've got the same level of risk, we all would feel that the expected return ought to be the same on various types of stocks, whether their earnings yield is high or low. We all know that earnings bounce around, and that a company could have a low earnings yield because earnings are temporarily depressed, or because expected growth of earnings per share is high. But for the market as a whole, a lot of these idiosyncratic things kind of balance out. And so the idea that the expected return on stocks is equal to the earnings price ratio actually makes a lot of sense. Now, is this the nominal return? Is it the real return? Partly it depends upon how earnings are calculated. And this is where Shiller has really popularized the earnings price ratio. It's frequently called the Shiller earnings yield or the Shiller price earnings ratio, or the CAPE, the cyclically adjusted price earnings ratio. Because what Shiller does, and this was first done in joint work with John Campbell, where they said, there's a problem with the earnings this year. Maybe the economy is in recession. Maybe earnings are temporarily low for the market as a whole. Maybe earnings are temporarily high because we're at the peak of a business cycle. And so they wanted to smooth out earnings to get a measure of kind of smoothed earnings. And they decided, well, let's just do a real simple thing. We'll take the average of the last 10 years, adjust for inflation, and just use that simple moving average of 10-year inflation-adjusted earnings as our measure of earnings. That's the cyclically adjusted price earnings ratio that Shiller uses. And this has become really popular among practitioners in recent years. The EP, the Shiller earnings yield, as a measure of expected real returns on stocks. In 2000, that ratio was only about 2%, 2.5%. And Shiller was predicting really low future returns on stocks. In fact, he published his book, Irrational Exuberance, with perfect market timing. He published it in March 2000, the exact peak of the stock market bubble in the United States. He actually wrote the book a year earlier, and he told me, I was really hoping the stock market would keep going up until the book was published, and he got lucky. Now, that's the expected return on stocks. To get the expected equity risk premium, we've got to subtract the expected return on bonds, and that raises the issue, well, short-term, long-term, what bond are we talking about? And that's a legitimate issue. In 2000, you could buy Treasury inflation-protected securities that were yielding 4% for a 30-year bond in the United States. So you could lock in a real return of 4% per year at the same time that the Shiller earnings yield was only 2.5%. Shiller thought the expected equity risk premium was minus 1.5%. I agreed with him. I got completely out of the stock market. Now, I didn't get the timing exactly right. I got out too early. But when the stock market then collapsed, when the bubble burst, I had no exposure to equities because I had put my money into tips. Now, then there's the issue of, well, when do you get back in? And I didn't get the market timing exactly right there either. But with the Shiller approach, the cyclically adjusted price earnings ratio, you come to the conclusion that, first of all, the equity risk premium varies over time. And you tend to come to the conclusion that typically when historical returns have been high, expected returns in the future are low. And it's got the real nice property that when the stock market is depressed, it's telling you this is when the equity risk premium on a point forward basis is likely to be high. So for instance, at the end of 2008, beginning of 2009, the Shiller price earnings ratio was relatively low because prices had dropped a lot. That 10-year moving average of earnings hadn't changed very much. And it said now is a good time to buy stocks. The expected equity risk premium is pretty high. And that's one of the reasons why Schiller and myself and many others didn't bail out of the stock market in 2009. And actually, I've been pleasantly surprised how well equities have done in the 6 or so years since hitting the bottom. But this Schiller earnings yield has become really popular for very good reasons as an empirical and theoretically very well justified way of estimating the expected equity risk premium on a point forward basis. Now there's still issues about should you use the arithmetic average or the geometric average, and should you use a short-term T-bill or a 30-year TIPS yield to measure the expected return on bonds. Given that equities are measuring a long-term expected return, I'm in favor of using a long-term inflation index bond yield. And so at this point, I'd like to get your opinion. Yesterday, Pablo Fernandez, for those of you who were at the keynote address, talked about the different measures, but he didn't state today what he thought was the right number to use. And I think somebody asked him what number, and he didn't answer the question. But I'm asking you to think for a moment, and then I'll ask people to vote, what you think is the expected equity risk premium today in terms of expected returns on stocks minus the risk-free rate. And to keep things simple, let's assume that we're dealing with the geometric equity risk premium. So the compounded return on stocks minus that compounded return on inflation index bonds. So think of what number you would want to teach your students, or if you're consulting or investing for yourself, how much extra return per year do you expect to get on stocks relative to long-term bonds? 30 years for the horizon. So long-term investing. Okay, so I want to take a vote now. How many of you think that equity risk premium on a point forward basis would be at least 8% per year? How many? One hand. Jerry Chow wants to be an outlier. How many think it would be 6 to 8% per year? A few hands. How many think 4 to 6% per year? Fair number of hands. How many of you think 2 to 4% per year? Fair number of hands. How many of you think less than 2% per year? Moderate number of hands as well. So we've got a fair amount of dispersion here. Just like in Pablo Fernandez's surveys, he gets a lot of heterogeneity. And actually, 22 years ago, when I was at the University of Illinois, right after Fama and French had published their paper on the cross-section of expected returns, we had a faculty luncheon at the University of Illinois, and we said, here's a company, a local company, what's their cost of equity capital? And everybody, all the professors wrote down a number, and the numbers were all over the place. Some people said as high as 15% per year, others said only 5% per year. There was no consensus. I think today the dispersion would be a little bit less, just like in this room. It wasn't real wide. But even among those of us who have spent a very big portion of our adult lives thinking about this topic, there's still quite a bit of difference of opinion. Well, let's look at some numbers today. Using this model of the earnings yield, earnings divided by price, there is a debate between Jeremy Siegel of Wharton, an author of Stocks for the Long Run, and Bob Shiller, author of The Cape Ratio, about what is the right earnings number to use. They both are of the opinion that this is the right model for the expected equity risk premium in the future. And Shiller and Siegel are lifelong friends. They went to grad school together at MIT, and the week before classes started, they were lined up in alphabetical order, and Siegel was right next to Shiller, and that's how they met. And they've become lifelong friends. Almost 50 years later, they still are very good friends. And they disagree. In fact, the last couple of years, there's actually been a pretty big debate between them where Shiller is using the 10-year average. Why is 10 years the right number? It's not. But 10 is a nice round number for people to remember. Partly it's about marketing. Shiller might have said, well, 9.3 years is the right number to use, but 10 is a nice round number. But the debate is that historical earnings number, is that biased? And today, this makes a difference. Because today, in the US, if you use the S&P 500, the current earnings yield on the S&P, using last year's earnings divided by price, is about 17, which would imply an expected real return on equities of about 5.5%. If you use the Shiller earnings yield, the price-earnings ratio is about 26, which would give an expected return on stocks of only about 4%. So whether you're using 4% or 5.5% does make a difference. What Siegel argues is there's a problem with the last decade in that if you use reported earnings, there have been a couple of times where companies have taken big write-offs. Like after the 2008 financial crisis, a lot of companies that had made a stock-financed acquisition and say bought another company by issuing $10 billion of stock, then said, oops, we made a mistake, it's only worth $2 billion, let's write off $8 billion. And those write-offs depressed that 10-year average. And Siegel argues, well, that's really kind of misleading because a lot of those profits had never been booked. Writing off the acquisitions is being too conservative, and so we ought to use operating earnings. And if we do that, then the Shiller number would be closer to a ratio of 17, not 26. And so Siegel agrees that the Shiller idea is right, that smoothing out the business cycle is a good idea. The only debate is, should you include write-offs in calculating those earnings or not? And quantitatively, it does make a bit of a difference. But if we use operating earnings, then today we'd have a number such as about 5.5% for the expected compounded real return on equities. And today, 30-year TIPS yield about 1%, so that would give a difference of 4.5%. And that's the number that I use. So 4 or 5% is the number that I teach in the classroom as a good measure of the equity risk premium today. Now, some countries, it might be a little higher or lower, depends upon how integrated you think world capital markets are. Like China is not perfectly integrated. There's been a bubble in China. The price-earnings ratio in China is relatively high right now. And so today, I think that the expected real return on Chinese stocks is lower than in the rest of the world. So If I was going to invest in Chinese stocks today, I would expect a lower real return than I would in many other countries. Now, there are three caveats to using this earnings yield model. One is mean reversion, and Campbell and Schiller point this out, that if the stock market is in a bubble, it's probably not going to take 30 years to correct that bubble. And so if there is a bubble, expected returns on stocks will probably be lower in the short term than they will over a 30-year horizon. But you never know how long a bubble is going to go on before it starts to pop. But if stocks are temporarily really low or temporarily really high, in the short run, things might be better or worse in an expectation than they will average over the long run. Another thing is using earnings numbers. It's implicitly assuming that there will be those earnings reinvested by the company or paid out to shareholders and not stolen by management or wasted. And in a country where corporate governance is a big problem, well, then maybe those earnings numbers might overstate how much investors can expect to get. And then there's the issue of, well, there is the chance of something really bad happening. And for some countries, this is a bigger potential problem than others. That just taking the last 10 years, you're implicitly assuming that this is a good measure of the future as well. And if it's a country where the last 10 years have gone pretty well, but there's a chance that something is going to get messed up really badly in the future, well, there is a chance of catastrophic loss, and you might want to adjust the numbers downwards a little bit for that reason. So, with any model, you can make it more complicated, make some adjustments, but I like to use the Schiller earnings yield as a starting point, although I do think Jeremy Siegel has a good point that right now, using the last 10 years where there have been some write-offs has underestimated earnings, and on the other hand, using current earnings might be a little bit of an overestimate because the economy in many countries has been doing well. Not necessarily in Europe, but in North America, things have been going relatively well recently. So Pablo didn't answer the question of what number to use. I'd like to think that I've answered, or at least given one person's opinion and helped justify to you why I think a number of about 4.5% today for the equity risk premium might be justified. And so at this point, I'd like to stop. And I think we've got time for a couple of questions. If anybody wants to violently disagree?
Some questions? I have one question to start. Don't you think that diversification is overvalued?
I'm a big fan of diversification. On the other hand, if you don't believe that markets are perfectly efficient, then things that are overvalued you should underweight. For instance, in 2000, I thought that in particular U.S. tech stocks were overvalued, and so I underweighted them. In the late 1980s, I underweighted Japan, but I'm still a big believer in international diversification. The last 6 years, Europe has not been a very good place to invest relative to the United States. But today, I still am internationally diversified, and I do tilt my portfolio. There is this tension between diversification and believing that the market is sometimes wrong and I'm smarter, but I realize, well, sometimes I've been wrong as well, and so I'm willing to put in some tilts. I'm not willing to risk everything.
And going with that, would you think that, suppose that we were investors, but I own a company, I mean, you're a major share of the company, and you're a minor investor. You are diversified, and I am not. Would we have the same expected rate of return for the entity?
Well, you would have the same expected rate of return, but the utility would be different. If you've got all your eggs in one basket, you should be. People should be willing to treat that as a lower certainty equivalent than if they're well diversified. And let me give you an example of an advantage of diversification. What if you lived in Greece 7 years ago and you had all of your money in the Greek stock market? You might have had a diversified portfolio of Greek stocks. You would have overweighted shipbuilding relative to the global market portfolio. But you would have lost 90% of your money if you had it all in the Greek stock market over the last 7 years. And that could happen in any country. So being globally diversified does have its advantages. It'll keep you from getting really rich. If you've got all your eggs in one basket, you've got more upside potential, but you've definitely got less downside potential as well.
Okay, thank you very much. Derek, you have a question?
If it is possible to predict with some degree of accuracy the risk premium in different countries, and we find that the predictions are different for different countries, I'm wondering if it's then possible to set up a long-short strategy to exploit that. I'm wondering whether that would work and whether any back testing has been done.
Yeah, and the answer to both of your questions is yes. It does work. It has been back tested, and you're going to do better 55% of the time. But there's still 45% of the time when things don't work out perfectly. For instance, in the late 1980s, 1987, George Soros, the famous hedge fund speculator, thought the Japanese market was overvalued relative to the US market. He was right. He shorted the Japanese market using stock index futures, $7 billion. He hedged himself by taking a long position of $7 billion in US stock index futures. And in the intervening 25 years, the Japanese market has gone down by 50%. The US market has gone up by, including dividends, about 10 times. He was spectacularly right in the long run, but he lost money in 1987 when stock markets crashed and the Japanese stock market went down 10% and the US market went down 20% in one day. So even if you're right in the long run, there's still the problem that you might lose a lot of money in the short run, and if you don't have that staying power, you can get into trouble.
What's your opinion about the current situation in US stock market, because valuations are pretty high? So I'm not sure if such a premium, expected premium, so 4.5%, taking into account the current situation at the current valuation level, is a good level which we could expect. Yeah.
Well, around the world today, stocks are less attractive than has historically been the case. Valuations are higher than historically they have averaged. That's why expected returns are lower. The problem is there is no alternative. TINA is the acronym that's used among some practitioners. There is no alternative. What about investing in German government bonds? You get like minus 0.1% nominal returns locked in, which is even higher than if you buy Swiss bonds. So the problem is safe assets are yielding very low returns today, and that's why people are willing to accept lower returns on risky assets because the alternatives just aren't very attractive. As an investor, I would like to earn really high returns, but they're just not available today. Okay, I want to thank you very much. I believe there's a reception now that the Stock Exchange is sponsoring, and I'd like to thank on behalf of all conference participants the generosity of the Stock Exchange.
Well, thank you very much.